Thank you for joining us. I'm Gord Long. I have Peter Boockvar with us today. Peter is the Chief Market Analyst with the Lindsay Group, a macroeconomic and market research firm. Peter's been with us before. Welcome back, Peter.
Thank you for having me.
Peter, busy morning. Brexit news breaking, so I want to get right into it. But can I ask you, because we have so many new listeners, just introduce yourself, your firm, your involvements?
Yeah, I'm the Chief Market Analyst for the Lindsay Group, a firm run by Larry Lindsay, the former Federal Reserve Governor and Senior White House Advisor. I'm also the Co-Chief Investment Officer for Boockvar Advisors, which is a separate investment management business.
What's your views is going on? What do you think is going to be the fallout of it, and what's going on in the markets here this morning?
Well, from I guess an economic and political perspective, I want to separate what will happen in the short term versus what will happen over time.
Please.
Certainly, the shock is going to lead to some chaotic type thinking. But I think over time we have to understand that the UK, at least from their perspective, however disruptive this is going to be, and I'm not going to deny that it will be a gigantic inconvenience and potentially a reason for continued economic slowdown just from a capital investment and confidence standpoint. But over time, a lot of these deals are going to get renegotiated, and the UK will adjust, and they will trade with Europe and deal with Europe just as Norway and Switzerland does. The real question more so is what this means for the rest of Europe and whether they can keep that experiment intact. And whether it means that Italy and Spain and Portugal, they decide to leave, that raises new questions. I don't necessarily think that's going to happen. I think having the euro is something that they want to be a part of, but that is a major risk, no question. It's also exposing a lot of fault lines within the EU with the bureaucracy that has caused the pushback against the so-called ruling class, but that's not only evident in Europe, it's certainly evident in the US as well.
Peter, you mentioned the others. I see Denmark is already talking about a referendum out here this morning. Italy's now bringing it. Marine Le Pen is mentioning it in France. It's almost like they're jumping on the bandwagon as this news is breaking. But a point I also make is that the failure of the EU in Brussels to address the refugee problem I have seen consistently in Britain as a major concern. I've had 330,000 new immigrants, and it's taxing their health, education, and other social services. And there's a real issue. And if they take Turkey in, another 77 million into the EU with free membership, how big a concern was that, do you think, socially?
No, I think that was a major concern. There's no question about it. But the UK has been in the EU for 40 plus years, and the immigration issue right now that's coming from these countries to me is just is a short-term issue. Now, I'm very sympathetic to the Leave camp. I believe, I'm an American. I believe in an independence, so I can understand, and maybe I would have voted for Leave in the UK. But to have the immigration issue to me was more of a short-term emotional decision rather than anything else. I would have been voting for a Leave more on a sovereignty and economic standpoint, not because of the immigration issue, but certainly if it wasn't for the immigration issue, I think it's pretty obvious that they would have voted to remain.
Moving a little bit from the short term, this reaction, and certainly the volatility we're going to see over the next few weeks, how big a concern do we have with the EU banking structure? Separate from this, we've seen a lot of concerns building here for some time.
Well, I don't know structurally, broadly speaking, with the European banking system, but on a bank-to-bank basis, they're getting crushed by the ECB and the flat as a pancake yield curve and the negative interest rates, which is a tax on their capital. That's the biggest threat to the European banking system and their over-levered balance sheets with too many non-performing loans, not the UK vote.
Where do you see this unfolding? What are the ramifications? Where are you focused? Are you expect to be focused yourself over the next week or two?
Well, I think we should remember what the underlying fundamentals are that we face every day, and that is slowing economic growth globally, and the U.S. that is falling earnings, falling profit margins, a loss of credibility on the parts of all central bankers, certainly the Fed, and the central bankers that have put themselves in a situation that they have nothing left to deal with it. And then on top of this, the underlying threat is an asset price bubble we've had over the past 6 years, which leaves us with no margin of safety in order to face all of these headwinds. That's my biggest fear. UK vote, yeah, we're going to get past that. And I even think maybe the European Union can adjust to it, because this is a gigantic wake-up call. And they have two choices. They either let this bleed away, or they say, we have to change our ways, and maybe some things for the better may come of that. But again, the global growth story remains very challenged. Asset prices are very expensive, and central bankers have lost credibility. Those are the risks that people should be mostly focused on right now.
That sounds like a perfect storm, actually, Peter, potentially. And I'm not trying to be doom and gloom here, because I just finished a long discussion with Richard Duncan about China, and he believes China's already in a hard landing. Imports are down 17%. We're seeing the slowdown in trade around the world here for quite some time. This is not a good time to have something as disruptive as this.
Well, China's been slowing for years, and no question they're going through their challenges. But who doesn't know that China's going through their challenges? Even the Chinese stock market's still down 50% from where it was in 2007. It's still part of a broader picture of slow growth. I mean, the S&P 500 just yesterday was just shy of all-time record highs. I happen to be more worried about the U.S. stock market than I have with the Chinese stock market at these levels.
Peter, where do you see, separate from this, where do you see the dollar and yields going? The U.S. dollar and I'll say, when I say yields, the U.S. Treasuries.
Past the very short-term knee-jerk reaction to sell the euro, sell the pound, the dollar has its own issues. The Fed is stuck at 37.5 basis points throughout this economic cycle. They likely won't be raising rates until the expansion after the next recession. So while it's easy to sell the euro, it's easy to sell the pound right now and other currencies and buy the dollar still has major issues. And really, the fair answer to that question is, which is going to be the currency that's left standing, and the only answer to that is going to be gold and silver, and that's obviously being reflected today. So yeah, the dollar's getting a knee-jerk bounce here, but I'm not a believer in a strong dollar, because I think it itself is facing major headwinds. Again, Fed's not raising interest rates, and the U.S. economy is slowing down continuously.
Is there a recession coming in 2016, 17?
I think the answer, this year we'll have a one handle on GDP. So going from current growth to a recession is not that far of a leap. I think the determinant of that is going to be what asset prices do, actually. I think if the S&P 500 goes back to 1800, then yeah, the odds of a recession grow. And the reason why I use the stock market as the potential swing factor is because the last two recessions were led by a decline in asset prices, tech stocks, and then housing prices. We have our third bubble in front of us. It's mostly been manifested in credit markets, but if you do get a decline in asset prices as it reprices to the global economic reality, that in itself could tip us over. At least in the U.S., the consumer is the only thing that's keeping us from a recession, and what can tip the consumer over is a decline in asset prices, at least from a psychological standpoint.
Fed policy seemed to be trapped. You just said you didn't see any more possibility of Fed increasing the rates, or at least that's what I thought I heard.
Yeah.
What do you think the Fed policy will be going forward?
The Fed has no policy right now. They're hitting, stuck in the forest on a path to nowhere. It's been winging it, play it by ear type policy for years now. They were so clear on how they were going to ease, and they've been in the clouds on how to exit. And I think the clouds are just getting darker and thicker, and they're stuck. They're stuck, they're trapped, and they essentially are running policy with their fingers crossed.
Summers, our former Treasury Secretary, is running around the world right now, in coordinated discussions, talking about fiscal stimulus, global coordinated fiscal stimulus, which needs to be pumped in to get the global economy going. Specifically, he believes it should be coordinated infrastructure spending. Comments on that? I don't know if you've heard that, but
right, yeah. So this is a Keynesian who believes in more Keynesianism as we suffer from failed Keynesianism. So yes, he wanted the $1 trillion stimulus package 6 years ago, and he wanted easy money from the Fed. And now that hasn't worked, he feels that more Keynesian spending is somehow going to make a difference. It's called look yourself in the mirror and do some self-introspection. That's what I would say to him.
Yeah, he wanted $1 trillion then. He thinks we need 6 to 12 trillion now.
Right.
Develop. So I mean,
same failed path.
If you don't have enough debt and throw enough money at it, just throw more. And if we look at Japan, I think we'd see clearly that it's the wrong plan in that regard. Where do you think we're going to be a year and a half from now economically? And I mean, that's a hard question to answer, I understand, but kind of. We don't know where we're going to be in 2 months, right?
I have no idea. I just know that the U.S. growth will likely continue to slow. You saw durable goods today that were very weak. You saw core capital spending within that is at a 5-year low and a level last seen 10 years ago. And this was even before the greater unknowns that are now coming out of Europe. So growth should continue to slow. Asset prices should continue to decline. Where we are a year from now, I don't know, but I at least know where I believe the trajectory is going to be over the next 6 to 12 months.
Yeah, exactly. Where I was going on that, Peter, to be a little clearer, was not economically as much as socially. I just sense when I look at the primaries, I look at the parties that are coming out in Europe, we have really growing social, maybe resentment's the wrong word, but we're going to parties we never supported. There's an anger in the electorate because they believe that, I think, that the system isn't working. They don't know why, they just know it isn't working. Are you observing or feel the same thing?
Well, that's clear. It's not a feel. I mean, it's obvious just by looking at the rise of Trump and Bernie Sanders. So it's obvious. The question is whether that voice sort of calms down after whoever is elected. Obviously, in an election season and a campaign, this is when people's voices are heard. And what happens after the election, we'll have to see. But yeah, I mean, that's apparent all over the world.
No, that's my point. So
discussed with the ruling class. Now, what that means, where that goes socially, I mean, who knows? It'll depend on a lot of different things. But people are having their voices heard, and hopefully the ruling class is listening.
I know we don't want to give investment advice, but if you got any suggestions what investors should be doing going forward here?
Right. I think, I mentioned gold and silver earlier. I think the whole commodity space has bottomed out. I think investors need to look where it is most painful to look, and that remains emerging markets that have already gone through a 5-year bear market, and to me have much better valuations than the developed world. And even in Europe right now, you're going to see obviously carnage. But there's probably going to be some opportunities through that. Maybe there's some opportunities in the UK if this selling continues because of the weaker pound. One thing I know for sure is that I'm very nervous about the US stock market, which happens to be one of the most, if not the most, expensive in the world. So again, investors should be looking at where it is most painful. They should be looking at where bear markets have already occurred, and that's predominantly in commodities, gold and silver in particular, and also emerging markets. One of the particular one that I like the most is Brazil.
Interesting. Peter, I know your phone has been ringing and you have it on hold here, so I'm not going to take up any more time. I really appreciate you giving us the time. Any last comments you want to make that we haven't touched on to our listeners?
Well, from an investing standpoint, one unappreciated asset class right now is cash. And while it's not going to make you anything in these very challenging economic and investing environment, it certainly won't lose you many on a nominal basis.
Can you tell our listeners how they can follow your work? I know you do a lot of interviews and your firm.
Well, the Lindsay Group website is thelindsay.com, and the money management business is bookmarkadvisors.com.
Have a good day.
Thank you, you too.